What is up guys, this is your ball Indian here, and today Senate Finance Committee Chairman Wyden is proposing a bill to end tax breaks on ETFs, and this is to fund $3.5 trillion social welfare and climate bill. Senator Wyden says that the constant theme running through our tax code is that paying taxes is mandatory for working people but optional for wealthy investors and mega corporations. So Senator Wyden is proposing to shut down this tax loophole which will generate over $200 billion over the next decade. But wait, what is this ETF tax loophole and how does this really affect us? Exchange traded funds or ETFs are just like basket of assets like stocks or bonds, and they can be traded throughout the day just like stocks. For example, let's say you want to diversify your portfolio to track S&P 500 index. Well, in order to do that, you will have to buy 500 stocks in those S&P 500. Not everyone can do that or afford to do that. Instead, you can buy one of these ETFs which track the performance of S&P 500 index. Besides their massive gain over the last decade, there are two main advantages of ETFs. Number one, transparency. ETFs are far more transparent into their holdings compared to mutual funds. Majority of the ETFs do disclose their trades on daily basis on public free websites. I'll link it in the description below. Mutual funds by law are only required to disclose their holdings on quarterly basis and 30 days lag thereafter. Simply put, with mutual funds, you're depending on a fund manager to make right trades for you, and you also give them an ability to take unwanted risk. Whereas for ETFs, they are passively managed and you let market play its own role. Second advantage, tax efficiency. Investopedia says, tax efficiency refers to structuring an investment so that it receives the least possible taxation. So that being said, if assets in these funds or ETFs go up in value and fund manager decide to sell it for some reason, then there is profit, which is capital gains. And funds by law, they must pay the shareholders this capital gains, which is you guys. And then you paid the taxes on these capital gains. On an average, mutual funds pay out 6.4% of net asset value in capital gains versus just 0.01% for ETFs. As mutual funds are actively managed to rebalance the portfolio, you'll be paying higher capital gain taxes. And because of stock creation and redemption magic, most ETFs don't pay any capital gain taxes at all. Creation and redemption is a process where authorized party institutions like JP Morgan, Goldman Sachs, and Morgan Stanley exchange a basket of assets for a block of stock or an ETF with the ETF issuer itself. Confused? Let's take a look at this. Here we are looking at a creation process specifically. So as you can see, there are four parties involved, both in creation and the redemption process. So there is exchange. For example, New York Stock Exchange is an exchange. Then we have individual investor, which is you guys who would like to buy an ETF. Then we have authorized participants, which are like institutions like JP Morgan, Goldman Sachs, and Morgan Stanley's of the world. And then we have the ETF providers. And the ETF providers are the one who are basically bundling these different assets in a block, which is also called a ETF. Here is the list of major ETF providers. So as you can see, when there is a creation process, we get an order from an exchange, then we can see that those assets are sent to authorized party, for example, a JP Sachs, and they would then just send this basket of assets to ETF provider. And then these basket of assets are bundled together for an ETF, which are again sent to authorized participant and then to the individual investor who placed the order. This exact process of creation and redemption is what makes the ETF tax efficient, because you're not settling for a cash, you're not cashing out of the position, but you're just moving your asset from one basket to another. And that's why we don't have any capital gain taxes on it. This is also a process which is termed as in kind in the new proposal. So do I really think this bill is going to pass and market is going to sell off? Well, let's first see what experts say. A fund manager from a big institution says portraying ETFs as an investment for wealthy goes against the nature of vehicles' potential benefits, and those who are wealthy would likely just shift their assets into other platforms or investment vehicles. Eric Pan, president and CEO of Investment Company Institute, says Wyden's proposal would make it more expensive for working families to build wealth, noting that nearly 12 million US households own ETFs as part of their financial planning, and would make regulated investments less attractive to younger Americans who are just starting to invest. Spokesperson at BlackRock said that they are considering about policies that would raise cost and reduce returns for long-term investors and retirement savers. ETF Trends Chief Executive Officer and Director of Research Dave Nadeau said it puts an ETF and a traditional mutual fund pretty much on the same footing, which means if somebody has to sell inside their portfolio, they are a taxable event. This is pretty regressive, and for that reason, I think it's pretty unlikely to pass. Okay, so here is what I think. I think it's too early in the stage to decide if the bill is going to pass or not. And I do agree with Dave, where he says there won't be any difference between ETF and traditional mutual funds if this bill has been passed. But please do follow me for the next update. I'll keep you guys posted. Please do consider subscribing as well. Thank you. Talk to you soon. Bye.